Hi everybody, welcome back to T.U.B Investing YouTube channel. Today I want to do an explanation about my opinion of 2023 and what I intend to do in 2023. I mean, in 2022 all of us probably had a very lousy year, so see, that's same for me. I had a very bad year, a very red year in fact, and I've actually done this over on YouTube with another blogger, not blogger, I mean a YouTuber, Bunty, which is my friend, and I've talked about this. But I just like to do a shorter version of it on my channel, and I hope it provides you some understanding of what I intend to do, right? Or why I intend to do what I want to do. So with that, let's move on to the next slide. So right now, actually, if all of us knows about, right, the fixed deposit rate has actually gone up, right? And right now I do even see 4+% of interest rate, fixed D rate that's given out to people, right? So I mean, if you look at if there's a return of about 4%, that's risk free, right? This means that actually risk premium has become lower currently this year, and risk premium is lower, right? People will not want to invest so much, right? And this is actually caused by the Fed repo rate, which is at 4+% right now. However, because people don't want to invest so much because the risk premium is low, and the Fed, and it's all caused by this Fed repo rate, right? People rather put the money in the overnight repo account, and there's actually 2 trillion on the sideline right now that I'll show you later, right? And if following that, there's all this recession talks with the Fed rate going so high. There's all this recession talk and the quantitative tightening, right? And this suck all the liquidity out of the market, right? Either because people are scared and want to stay on the sideline until the recession comes, or because of the quantitative tightening, that people just don't want that people just need the money to pay for other things right now, right? But I have to state again, there are over 2 trillion on the sideline right now, and this will be shown later in the overnight Fed repo rate. So with that, right, for funds, right, they continue to stay invested in the market. So I would say the liquidity in terms of sucking out of the liquidity out of the market is probably the retailers, the retail investors. Funds are still in the market going through their merry-go-round, right? I mean, you can see that since 2020, right, they went from growth to meme stocks to crypto to now they have gone into defensive and value plays. You can see later in the ratios that you can see actually this defensive value plays have ratios that's similar to the big tech, right? Which this comes to the last point where the market overreacts, always overreacts. And when this happens, what is my opinion of what I want to do? Right. So we can see here, Fed repo rate is high at 4%. If you have 4% interest rate, why am I risking in an environment that there's going to be recession next year? Why am I risking my funds, money in it? So I keep on the sideline. This is actually November 7. They're actually 2.2 billion, right? 2.2 trillion as of November 7. In November 25th, today there's actually 2 million. So there's a drop in the Fed overnight reverse repo, but there's still over 2 trillion on the sideline, right? And this market is just waiting. This is just waiting for the market to either crash, recession to come before they actually invested this money, right? So this money is just on the sideline right now, not even in the economy. That's why with this, all the liquidity is here right now, right? And those remaining in the market has actually gone from all the so-called risk-on investment to the risk-off investment, this defensive value plays. As like I said, the funds is in the merry-go-round, and you can see here, like for example, Procter & Gamble PE is at 25, Google PE is at 19, right? Big tech. I mean, even big tech has so-called crashed over the last few months already. So I mean, if you look at Coca-Cola is 27, Pepsi at 26, they're all higher than Google, Meta. I mean, some of them even higher than Microsoft, and even Apple itself, right? Which is the darling of the market, investment US market, right? So this shows that as I stated just now, funds is going into defensive play right now. So what is my opinion in 2023, right? So I want to focus on the fact that on the point of what will happen when the Fed pivots and the economy recovers from recession, right? So when everybody is just saying all this recession talks and stuff like that, right? People are just worried and they stay on the sideline, right? But what happens if those that are investor, right? They're actually planning their move already. So if you listen to what is the news out there and stuff like that, right, you will miss out the chance, right? So my opinion is I'll continue to focus on big tech, ETF maybe, probably. If you don't really know what to do, right, you can focus on this. Or if you have conviction play, you continue DCF into them. If you have the cash, obviously. Don't shift into defensive play right now. If you go inside, it's damn expensive in my opinion right now. I'd rather go into this big tech and stuff like that is being sold down aggressively already. So as I said, no point switching to defensive play because we don't know when funds will switch out to another point or when Fed pivots, right? We don't know. We cannot time the market right now. And if you choose properly, I think there's always this term going around called generational wealth, right? You may even have an opportunity to obtain that, right? And if you are interested in speculative companies, for example, and turnaround companies, which I do have some in my 10 companies listed that I intend to talk about. So I would say that these companies are one that are priced for bankruptcy, and many are actually not in that stage right now. So this speculation company could also, if you want to invest in them, smaller allocation, put aside amount that you don't mind losing out, right? And this speculation could eventually become generational wealth. If you are really, really so interested in any of the speculative companies or these turnaround companies, so-called, please do your super deep dive into it, right? So with that, right, I just like to say, please do note that I'm not a financial advisor right now. I like to end up with that I'm not a financial advisor. Whatever I say here is just my opinion. And do subscribe to my channel. Thank you, and I hope to see you in the next video. Bye.